Good afternoon, everybody. My name is Matthew Roy, Fund Development Analyst here at SSQ. We are pleased to welcome today Jan Sterev, Senior Vice President, Client Service, Institutional Markets, and Laura Cohen, Global Equity Specialist. They're here to talk to us about Fiera Global Equity Fund and how it is built to focus on the long term. So without further ado, I'll give the floor to Jan.
Thank you very much, Matthew. Welcome to everybody. The idea of today's presentation is to take a couple of minutes and give you a brief overview of Fiera Capital, who we are, and I will give the floor to my colleague Laura, who is involved in the global equity team and who will give you a brief overview of the approach, but who will also dig down a bit on some of the examples of securities we hold, and we will definitely look at characteristics of the portfolio and give a couple of pointers in terms of the performance. I would invite you to go to page 4. And on that page, again, a brief overview of Fiera Capital. We are an independent Canadian investment management firm with offices across Canada, and we definitely value the fact that we're more than 600 employees and 150 investment professionals. Our assets under management are close to 130 billion, and our main clients are institutional clients. That information, you can see it on page 5 with the pie charts in terms of our market segment. So institutional clients like the platform of SSQ in terms of asset classes. Equity represents 42% of our assets, with global equity being the main asset class. When we talk about global equity, we talk obviously about investments across the world, but we also have U.S. and international mandates. In terms of our regional segmentation, obviously we have pension plans, other type of clients, the SSQ platform. We have clients across Canada, but we're also present in the U.S., Europe, and also Asia. On page 6, just before giving the floor to my colleague Laura, you kind of see our offering. We have a number of approaches that are on the SSQ platform, but today we're going to focus on the global equity. You see it on the 4th column with the team that you can see here that are involved in the management of the portfolio. And my colleague Laura will take the floor, talk to you about the team, the approach, and definitely give you some insights on the way that we do things are on our end on the global equity. And I'll take back the microphone a bit later on when we're going to go on the performance pages. And if there's any questions, I think at the end of the discussion, we will have potentially a couple of minutes for and maybe potentially take some Q&A from the webinar. Thank you.
Thank you, Jan, and thank you everybody again for being with us today. So we'll start with an overview of the global equity team presented here on page 8. So the team has been managing the global equity strategy since 2009 when Nadim and Andrew joined Fiera. The core of the team has been together since the very inception and has been extremely stable since the inception of the strategy, with the addition of the analysts presented on the 3rd line, so Wen, Ivana, and Isar. So the last hires are actually part of our internship program, so we weren't necessarily looking to hire anybody, but we couldn't pass on the caliber and the talent of these individuals. The way that the team is structured in terms of research, so research is divided by global sector of coverage, so not by region, etc. The team actually runs a very collaborative approach. However, in terms of the final decision making, that's done by the lead portfolio manager, Nadim Risk. As for Andrew Chan, so he acts as the head of research, very much hands-on on a daily basis with the analysts, and also is constantly working on improving our processes and improving our tools. A final note on the team is the way that they're compensated, which for us serves as an alignment of interest with our clients. So the entire team is compensated on the added value of the strategies. And we believe that this not only serves as an alignment of interest with our clients, but also ensures that everyone has a vested interest in participating in decision making. As for Tim and myself, we are here to ensure that the team is entirely focused on the research and portfolio management, and we will basically have all the relationships with the clients and help internally as well. On page 9, we have the strategy profile. So as we see, our investment approach, so we're fundamental bottom-up investors, and what we're looking to do is to identify high-quality companies that have sustainable competitive advantages and hold them for the long term. As for our assets, in total between our global, US, and international, we're managing over $27 billion. Specifically, our global has seen the most traction because it is considered to be the best ideas of the two, and we are managing over $15 billion as of December 31st, 2017. In terms of number of holdings, we currently have 38 names in the portfolio, and we expect that range to vary between 35 and 45 names. Getting to page 11, our investment philosophy. So we believe we could achieve superior and sustainable returns by investing in a concentrated portfolio of high quality companies and holding them for the very long term. So breaking down those keywords, we spoke about concentration, high quality, and long term. Looking at concentration, what that does is it forces us to be very selective and very disciplined to only own our very highest conviction ideas. In terms of high quality companies that we're looking for companies that have an economic moat or who are able to sustain competitive advantages over the long term. So they have things like high and sustainable ROIC. And also by investing in high quality businesses, we are mitigating the business risk. And hence for us, that's our number one way of preserving capital, which we define as a potential for permanent value destruction. Finally, in terms of long term, so as I mentioned, we're long-term investors. Our holding period is about 10 years, and for that we could deduct that our annual turnover has historically been approximately 10%. So being long-term investors not only allows us to take our time to know our company extremely well and build relationships, but we also benefit from the compounding effect of value creation. Page 12, we can skip on because we already just basically summarized those statements, so we can dive directly into the investment process and get to page 14. On page 14, on top, we basically have the 4-step process of our investment. So first, we start with idea generation. How do we look at ideas? Well, it could be through company meetings. It can be through existing holdings. So for example, we hold in our portfolio intercontinental hotels groups. So that could lead us to look at some of their competitors like Marriott, for example. We can also find ideas through our internally developed or proprietary screening and ranking process, which we see on pages 14 and 15, which essentially allow us to take a universe of approximately 7,000 names and whittle them down to a workable universe by filtering based on high quality metrics. So what are we looking for? We're looking at metrics like ROIC, profitability, low leverage, and liquidity. Now we have an addressable universe of about 1,400 names, and that brings us to page 15. Page 15 is where we have our ranking process. So once we have an addressable universe, we can either rank by that universe, by country, or by sector. Once again, what are we looking for? We're looking at quality metrics. So we're looking at things like ROIC, ROE, operating margins, we're looking at valuation, and of course we see a 50%, so we put a lot of emphasis on quality. We look at valuation, so we're looking at things like EV/NOPAT, like DCF models, looking at relative valuation, and looking at growth metrics. So that allows us to rank our companies and able to look at the top 25%. So on page 16, I've probably mentioned the word high quality a couple of times already in the last few minutes. So what do we mean by that? So we're looking for companies that have sustainable competitive advantages, so high barriers to entry that are market leaders. We'll take, for example, a company like Nike. So Nike has high technological barriers to entry in sports footwear. They're constantly able to innovate and launch new products. Recently, during their Investors Day, they spoke about innovation of 3 new products, so VaporMax, Vaporfly, and a sole that's called React. We look for companies that are in attractive industries that are growing, so we're not looking for deep value companies that are in a secular decline. We're looking for growing companies with low capital requirements. So we can take, for example, companies in the information services business like a Moody's or an MSCI. These are growing business with secular trends for more ETFs, so that's great for indices, for example. Looking at companies that have strong pricing power. So if we take, for example, the luxury company that we detain called Richemont, they own brands like Cartier. Cartier is able to basically increase their price by 5% and the demand would hardly move. That's pricing power. We look for companies with a demonstrated track record, so consistent and a high ROIC, that have superior operating excellence and make good capital allocation decisions. So are the companies paying out dividends? Are they buying back shares? Are they making value creative acquisitions? So one of the companies we detain called IHS Markit, which is an information services company, has a very strong acquisition track record, which has created a lot of value for them over time and have been very strategically important acquisitions for them. Of course, everything starts from the top. So we look for businesses that have strong management teams and sound corporate governance. Take, for example, Unilever. Unilever not only has a strong board and corporate governance structure, they go beyond that and have a whole sustainable living plan to improve health and reduce their environmental footprint while growing their business. We also look for companies with strong balance sheets, so low debt, high cash flow generation, and that contributes to capital preservation. And finally, we want to be able to do all this at an attractive price or something that we consider to be reasonable. Going on to page 17. So within our in-house proprietary and documented rigorous research process, we look at things firstly like industry dynamics, the management, proprietary financial modeling, and finally, we'll grade our companies based on something that we call our test of time scorecard. So this is something that's proprietary. Test of time is a play on words. We want to make sure that our companies are able to stand the test of time. And what it stands for is track record, industry attractiveness, management quality, and economic moat. This for us is a standardized and repeatable way to be able to compare and grade our companies that are in 2 different industries and 2 different countries. On page 18, we will see how we break down this time score. So we have 3 positive sections. So basically, there are 3 sections that can attribute positive points, where the points are attributed between 0 and 4. The 3 categories are economic moat and industry attractiveness, which you'll see has the largest weight at 55%, and that includes things like Porter's 5 forces and the sustainable competitive advantages. We'll then look within the business, look at the business attributes, the capital intensity, the organic growth profile. And afterwards, look at the management and track record. So as we mentioned, what kind of capital allocation decisions are they making? Finally, we'll have a negative section or negative factors where we'll look, for instance, at potential litigation risks or regulatory risks, which we'll see are more predominant, for example, in the financial sector. We'll look at red flags. So this is a whole section of governance issues, for example, like board independence, non-independent chairman, and also ESG considerations. So taking, for example, one of our holdings on slide 19, Moody's. So Moody's, which is a leading provider of credit ratings, research, and risk analytics, Moody's meets our high quality attributes in terms of being a strong business with high barriers to entry and a limited number of players. Essentially, Moody's and S&P really dominate the market. Moody's also has excellent financial metrics with high margins and ROIC. They also have very strong pricing power and good growth drivers. They also generate significant cash flows and have a demonstrated track record in terms of capital allocation decisions where they return capital to their shareholders. So now on the following page, page 20, we'll see what does a time score actually look like. So on the second blue line, we have the actual score of Moody's. So Moody's has a very high time score of 92.6. On the line above, you'll see the negative factor, which in this case is attributed because of potential litigation and regulatory risk, which, as I mentioned, is very prominent in the financial sector, so we will automatically ding it. On the right-hand side, you'll see the governance red flags, where if we have more than 3 red flags, we will automatically deduct 2.5 points from the score. Once we attain 5 red flags, that can have a negative impact of up to -5 points. So again, this can impact the score of the company. So we do this for every single one of our companies that we detain, and for every company that we're researching, we'll have a time score. And this score will actually impact the weight and when we're doing our portfolio construction decisions. The next few pages are just additional examples, so we can actually go ahead to page 25. Page 25 talks about our ESG. So first of all, from a firm perspective, Fiera has been a signatory of the United Nations Principles of Responsible Investing since 2009, as well as other organizations. Fiera also put in place an ESG committee to work on constantly improving our practices and putting policies in place. From the global equity team, so the global equity team has always had corporate governance been a key area of focus in identifying high quality companies since its inception. And we look at it essentially as potential risk factors. And this can impact not only our valuation, but can also impact the score that we will give ultimately to a company. And as long-term shareholders, we know our companies extremely well. We're able to meet with management, and we can actually make an impact. And in order to do so, one thing that we find very important is that we vote all of our own proxies. So while Fiera has a firm policy and we also use external expert provider, we will vote all of our proxies, so Nadim Risk as well as the analyst in question, because we believe that one of the best ways to be able to understand the culture of a company is by voting their proxies. We track all of this, and important to note that every single thing that we do, whether it be the research reports, whether it be financial earnings or news flows, every single thing is documented clearly. So that ensures that we have a continuity in place. As a summary on the process, on page 26, there are 4 pillars of our investment philosophy. So we pick what we believe to be our best of breed or our best idea companies at what we consider to be attractive valuations. And by holding a concentrated portfolio, we're able to develop a deep understanding of these companies, and we hold them for the long term. We constantly and appropriately reallocate our capital to companies based on our conviction as well as the risk-return potential of a company. And historically, we have never deviated from our approach. We have consistently applied our investment philosophy and approach since inception. And thank you, everybody. I will pass the mic to Jan for performance and portfolio characteristics.
Thank you very much, Laura. I hope this gives us a bit of color in terms of the way that we look at global equity in our firm and in terms of the approach that we try to apply and going forward to achieve returns that are up to par. If we look on page 28, you have the returns since inception of the strategy, which is 2009. We are partners with SSQ since mid-2016 on the global equity side. So we will focus a bit on the recent performance, and we'll try to give you some pointers on that side. You can see that as a whole for the year 2016, we were slightly behind the index, but the main explanation of this was Q4 2016. Following the U.S. election, there was a strong run on the commodity sectors, and this is an area that obviously if we're looking for quality, we will underperform in those strong, let's say, lower quality or commodity run periods. That being said, 2017, we didn't make any changes into the portfolio in Q4 2016, and you can see how the performance in 2017 has been exceptional with an 8% value add. You see the long-term numbers. I'm going to point to you also the 2011 year. You can see that the MSCI World had a negative return, while our composite, our global equity strategy, overperformed. That brings me to, again, you can see the annualized numbers and almost 5% value add since 2009. But this brings me to page 29. And a couple of elements that we wanted to show here is that the key metrics, and you can see that we have a very good up market capture with 109%, and an excellent down market capture of 69%. What do we mean by that? We mean that if the market, and historically the market, going up 100%, well, we did slightly better at 109, and if the market was down, we were able to protect capital, and we were only down 69% if the market was down 100%. Another key metric is the information ratio, 1.3%. That's an excellent number in order to show the quality over the long run of the approach. If we move to page 30, so maybe just give you a bit more color on those metrics. This is something that's the source of this page is eVestments. It's a leading provider of information on portfolio managers. What we spoke about, the up and down market captures. The message here is that there were 221 portfolios that were analyzed for this information, and we rank very well in those two metrics. And as I mentioned before, the information ratio metrics, we're in the top 5 among those 221 managers in terms of being able constantly to do a good job in an overall global equity portfolio. I will pass the mic to Laura again. She will focus on some of the page 31 is, I like to say that it's our bulletin card. Basically, it shows how at the end of the year the portfolio measures up versus the index. And Laura will also give you a bit more example of some of the names in the portfolio and the regional and sector allocation of the portfolio.
Thank you. So yes, just going back a little bit as to what happened in 2016 and 17. So as Jan mentioned, after the election of Trump in Q4 2016, we saw a rotation in the stock market drivers. So as mentioned, lower quality cyclical stocks had a strong run, and we are, of course, high quality investors, so this is not in our favor. However, this is not something that surprised us, and when there is a risk on trade or commodity cycle, we do expect to lag a little bit. However, when there is a low to moderate growth environment, or what we consider to be a rational market, this is where we outperform and have historically shown to do so over the last 9 years. The strategy is made up of high-quality companies, so it's very well positioned to protect capital in more difficult market environments, as Jan has just shown with our attractive down market capture ratio. Now, going back to 2017, we saw a reversal take place in Q1, where our outperformance was actually mainly driven by our focus in owning high-quality names. So looking at our attribution and what we expect to see and like to see is that the vast majority came from our security selection. And some of our top contributors over the year were Keyence and Moody's. So Keyence is a Japanese tech company of laser sensor related solutions, and it's used for factory automation. And that was the #1 contributor this year due to a couple of factors. So one, it continues to benefit from industry trends, so requirements for higher quality, more efficiency. So as those requirements continue to increase, Keyence continues to benefit from this demand for more factory automation equipment and for their solutions. Secondly, the company posted very strong earnings throughout the year, and because of their sustainable competitive advantages, Keyence was able to generate 50% operating margins and very high and stable ROIC. Keyence also capitalizes on its expanding direct sales force, so they don't use an intermediary, and also their innovation and direct distribution allows them to sell at a premium. For Moody's, so Moody's was the second top contributor over 2017, so the credit rating agency that we discussed before. They rebounded from Q4, where it had actually been the top detractor because of a couple of factors. So first of all, there was an uncertainty regarding the payment that they would need to pay the Department of Justice for a litigation that dates back to the financial crisis. So you remember how we dinged it, sorry, with minus 2.5 in the scorecard for risk of litigation is for risks such as these. So they ended up settling with the Department of Justice in January 2017 for less than had actually been anticipated and modeled into, and less than the S&P had paid for. So that was very well received by investors and removed uncertainty in that regard. There has also been basically uncertainty or fears relating to the possible fiscal reform from Trump's government. So finally, that ended up being a little bit mitigated and the fears were less pronounced than anticipated. And finally, another reason for their outperformance was their announcement of the acquisition of Bureau van Dijk, which is a Dutch information services company that provides private company data. So what essentially Moody's is to the public sector, Bureau van Dijk is to the private sector. And they, basically the investors thought this was very well received, and they thought that this would be a good source of growth, and it made strategic sense for Moody's to do such an acquisition. If we look at the underperformers over 2017, we saw a theme throughout the first 3 quarters of the year where the retailers, and especially U.S. retailers, underperformed. And that was because of fears that essentially Amazon was ready to take over the world and fears of e-commerce. We actually saw a reversal or rebound of these, in part of these retail companies over the 4th quarter. However, our top 3 underperformers were AutoZone, Tractor Supply, and TJX due to this common investor fear of e-commerce. Okay, now getting back to our presentation, we can go to page 31. Okay, 31, where we'll just draw your attention, as Jan mentioned, this is essentially our scorecard, 31. So what we'd like to point your attention to is the risk metric of net debt to EBITDA, where we see that our leverage is relatively low to that of the index, where we see a minus 42%. Now, looking at the profitability and growth metrics, not surprisingly, as we're looking for companies with these sustainable competitive advantages that have high return on invested capital, we see that our ROIC is 25.8% compared to that of the index at 10.6%. Historically, we've always seen through time that our ROIC has been 2 to 3 times that of the index. That's also true in terms of our operating margins at 23 versus the MSCI World at 14%. So this has historically been proven through time, and this is essentially our scorecard where we do not deviate from these high metrics. In terms of number of securities, as mentioned before, we have 38 securities. If I were to look back actually on page 30 quite quickly, looking at the standard deviation, we have 38 companies with a standard deviation of 9.7, whereas the MSCI World has over 1,600 companies at 9.5. So we see here that we're not taking additional risks by having a concentrated portfolio. Finally, looking at the portfolio positioning on page 32, as mentioned, we are bottom-up investors. So what we're really looking to do is identify high-quality companies no matter where they are in the world. So companies that have good governance, that have clean balance sheets, that have high ROIC. So our sector allocation and our regional allocation will, for the most part, be a fallout of our security selection. However, we do have constraints in place. For example, we have to be invested in a minimum number of sectors, and there are sector deviation constraints to ensure that we have an adequate amount of diversification. Beyond that, the team actually looks at diversification on a more granular level, looking at the diversification by end markets, by growth drivers, et cetera. And our top 10 holdings are approximately 38%. You'll see that our top 10 names, if I think about companies like Moody's, Keyence, MasterCard. These are all names that we've detained for over 10 years. So our conviction in these names is extremely high. So when we enter into a position and we buy a new position in our portfolio, we will start at a more moderate or weight of approximately 1%, because historically we found that that's also another one of the best ways of mitigating risk. Because yes, we've spent a couple of months on research, however, we want to make sure to increase our conviction before augmenting our position in that stock. So the top 10 securities are securities we've held for a very long time that we know the ins and outs. To wrap it up, so why invest in the global equity strategy on page 33? So long-term investing ensures emphasis on high quality, best-of-breed companies and consistency of performance. Our strong discipline approach from which this team has never deviated from. We have a rigorous research process which ensures that we have a very deep knowledge of portfolio companies, and we consistently have seen success in this approach. We have a high conviction focused portfolio with diversified sources of alpha. We have a broad universe of potential investment opportunities. And finally, we have strong risk-adjusted returns and top ranking relative to our peers.
I hope this gives you a good indication in terms of how we do things on our side with the global equity. We, again, definitely value very much the partnership we have with SSQ since 2016 in this segment. And hopefully, we definitely look forward to building on this relationship. I will pass the mic to Matthew, and if there's any questions, don't hesitate. Laura or myself can definitely give you some color on potentially some of the questions that might be coming from the webinar.
Okay, well, thank you. We received a lot of questions, so we won't be able to answer all of them. The first question goes like this. I believe that you have been absent from the energy sector for quite a while. Is there any particular reason why? And are there any particular companies in this sector that are interesting for you at the moment?
Hi, thank you for that question. So I'll actually bring back your attention to some of the high quality company attributes that we look for. So when we're looking for companies, we first look at the industry and the attractiveness of the industry for us. So we're looking for companies that are growing, that have low capital requirements, that have strong pricing power, and that are not cyclical. So if we think of companies in the energy sector, they do not have pricing power and they have high capital requirements. So as for now, we have not found many ideas that could meet our criteria in terms of high quality companies. And there's also equally, of course, we have our environmental, social, and governance factors which we apply. And in terms of the environmental factors, this is a bigger risk that is also a consideration.
Okay, well, thank you. Second question, the FANG stocks like Facebook, Amazon, Apple, Netflix, and Google had a huge year in 2017, but they are getting quite expensive. Could you talk to us about one of these companies that you have in your fund?
Sure. So, as you're able to see, our strategy, even if you take away Q4, has done extremely well and has done very well throughout time, even without the FANGs. And that's true. That was true in our global portfolio, and that was true in our U.S. portfolio. So that shows you actually to what extent picking your companies and having high quality companies could trump having some of these mega caps, and we were able to do very well without it. However, we absolutely did initiate a position in Alphabet, or the holding company of Google, in Q4. And people will often ask us, well, why now, or what took you so long? And the first thing that we do when we enter a company is that we have to be absolutely comfortable with the industry and the rate of change in the industry. So this is a rate of change which is a little bit, let's say, faster than we were used to understanding. So we have to have that conviction and that understanding in the rate of change. And not only in the industry, but also have conviction that the management will be able to navigate and constantly remain at the forefront and be number one or number two in any of the platforms that they are in. So that was for Alphabet. So now they have a second generation of management. We've seen a demonstrated track record. They have a culture of innovation, and we have complete confidence in their management. However, that's not to say that we do not acknowledge that the rate of change in the industry is high. So if you were to look at our time score for Alphabet, we'll actually give it a pretty low ranking in terms of rate of change. So this is always part of our risk-return analysis of a company, and that's affected also in the weight that we're willing to attribute to it. We've also presented over the last couple of years some of the other names, including Facebook and Amazon. And for now, these are not names that we are comfortable with for a number of reasons. So as you mentioned, valuation. So Amazon's valuation is extremely high. So relatively speaking, Alphabet is a lot more attractively valued. And you also need all sorts of financial almost gymnastics to be able to evaluate Amazon, and that's not something that we yet have a comfort level in. Facebook also, so you'll see a lot of times if we are not fully comfortable with it, it's often related to the industry. So we are not sure that we are completely comfortable with the rate of change of the industry in Facebook and where it will be in the next couple of years.
Great. Well, this concludes the presentation. Thank you very much, Laura and Jan, for your time. It was very interesting, and we learned a lot. To all of you who have listened to the webinar, thank you for your participation, and come back in March as Tria Sima's team will discuss their Canadian Equities Fund performance and positioning. So thank you very much. Have a great day.
Thank you.